Hey everyone, Nicole Del Priore with Keller Williams San Diego Metro, and I have with me here today
Scott.Criss, loan officer, CrossCountry Mortgage.
And we're just going to talk to you today a little bit about the rate cut that took place yesterday and what does that actually mean for you, the buyer, or someone looking to refinance. So, Scott?
Yeah, so I think the first thing to understand is why did the Fed cut the short-term rate? Last year, we saw the Fed increase the short-term rate. So why all of these squigglies, right? So first off, last year they were increasing the short-term rate in order to slow down our economy so it doesn't grow too fast, because that's a bad thing. On the flip side, if the economy is going too slow, they're going to decrease the short-term rate to try to stimulate the economy. So, so that is why the Fed does it. Now, when they lowered it 0.25%, did that impact 30-year fixed mortgages? Like, did they go down 0.25%?
And that's the question that everybody's been asking. So.
No, it didn't, because you figure the Fed controls the short-term rate, not long-term rates like 30-year fixed. Short-term rates are more of like your home equity lines of credit, okay, short-term, credit cards, short-term. So that's what the Fed really lowered. So you can't really combine the two. Now, does it impact 30-year fixed mortgages? And indirectly, yes, it does. So when the Fed cuts the short-term rate, first thing you have to understand is traders are going to trade based on their assumptions of what's going on in the market, what's their predictions. So when the Fed cut the short-term rate, did it that day have any direct impact? No, because the Fed already said, hey, we're going to cut the short-term rate. So trading was already being based on it actually being cut.
Okay, so like the rate's basically already reflected.
Yes,
so it
exactly.
didn't actually touch it.
Not 30-year fixed.
Yeah, gotcha.
So what we kind of can take away from this is interest rates are already trading at about a 3-year low, and that's because of the economy in the state that it's in. The Fed cut the short-term rate as expected because of the state that the economy's in. Gotcha. And so, so right now, rates are already reflecting that change. Now, the Fed came out and said, hey, we're going to cut it 2 more times, right? So guess what? Traders going to trade as if it's going to be cut again. So, so yeah, you're not going to see like an instant trade cut, an instant decrease in rates, but the economy, it's a great pulse of what's going on in the economy. And yeah, that's all I have to say about that.
Gotcha. Well, thank you so much, because I mean, unless you're really knowledgeable about how all this works, you know, my knowledge is in the real estate market, not necessarily the lending market. So it's good to have people like Scott here to kind of break it down for us. And if you have any questions, you know, at all about what this means for you as a consumer, please feel free to reach out to either one of us. I'll post our information at the bottom of this video. And thank you so much for joining us. And we will be back with you in a few weeks to talk a little bit about the housing market, what it's doing, as well as what's going on with the interest rates. So thanks again for joining us, and I hope you all have a wonderful afternoon.
Take care, guys.
Take care. Bye.